rant. Hey, good morning. Welcome to Coffee with KPP Live, the show that's dedicated to providing you with advice for life so that you can live richly and work towards the life that you've earned. My name's Kyle Roy, joined with Ben Hopper. We are financial advisors with Kentucky Planning Partners. Thanks for joining us.
Yes, I'm glad to be back on the show. You know, this past weekend I was down in Bowling Green at the WKU homecoming festivities. So we had a great time, but I had several people, come up and ask me like, hey, I love seeing the Facebook videos. When are you going to be back on? And so
I think what you told me was, who's that guy that's always on Coffee with KPP Live? When are you coming back on? Isn't
that's
that
right. Oh yeah, they
don't like me.
They don't. They're not a fan of Kyle. They're a fan of Ben.
They should be. They should be a fan of Ben. So Ben is. Hey, you got something to announce though. What's your new status? Your role with your fraternity? Tell everybody about the role you've got. It's a big deal.
Yeah, so I'm currently our president of the Alumni Board. So essentially we're in charge of managing the house through SIGEP. And so I'm on the board as president, and that happened in July. So I'm excited to do that, but just an extracurricular activity. As advisors, we like to be in the community. We like to stay involved, whether that's through college, alumni type things, or Kyle's plenty involved with church and various other activities, schools. So we like to be in the community. That's
He's
what
being
I like
modest. He is a leader in the community down there. It's funny, you go down to WKU with Ben, and he's literally like the big man on campus. Like you are an awesome pillar of that community. You do well for the students that are there now. You've done well for your friends when you were there. So congratulations. That's not something to take lightly.
And at homecoming, I was even talking some with President Caboni, who asked about our Coffee with KPP show. So that was awesome. So President Caboni, if you're watching this, I'm back on and we're on. So thank you for the support.
And it's because of you. It's because of you. It really is.
But I guess we're not going to be doing this Facebook Live anymore. It's going to be Meta Live. Is that what I understand?
Oh, good point. I have no idea. We need to think about the rebrand for that. That's a great point. What happened with Meta this week? That's tell the crowd.
Well, for those of you who may or may not know, Facebook announced recently, that was a big headline in our world, was that the new name Meta is what's going to replace Facebook. So many of you probably saw that. We don't know how that's going to shake out. We're not going to talk much about that, but it's just an interesting
and we
factoid.
Are not KPP nor KPPAS nor LPL are affiliated with Facebook, Meta, or anything like that. We are not making a stock recommendation, but
that's right.
Facebook will no longer exist as Facebook. It will be Meta. So, speaking of the things that are in our world, one of the things that we've been really passionate about lately is the worker shortage. I know a couple weeks ago we put out a video I did talking about the worker shortage. It's something that I think is affecting us all, and it's the worker shortage and inflation, I think, in the economy are the two biggest hot topics or talking points that's on everybody's mind. So what we're going to talk about today is really how the worker shortage and the labor shortage is really a sign of inflation and adding to the inflationary problem. So we're going to talk about that, and we know it's something that everybody's talked about. Leslie, our marketing director, who's behind the camera, was just talking about how long did you wait to check out of the grocery store this week?
20 minutes.
20 minutes to do the self-checkout line, right?
Correct.
20 minutes to do the self-checkout line because there wasn't anybody available to work the checkout lines at the grocery store. So it's not just restaurants, it's grocery stores. And we're going to talk about how in the larger economy, it's everything from shipping to manufacturing to freight and everything to the what am I thinking? The shipping containers come in. The ports have a glut of shipping containers where we can't get the supplies we need, and labor is a really big reason for that bottleneck. So we're going to talk about that.
And what we want to focus on is what does that affect? How does that affect us as financial advisors in our world, the economy, the markets, that sort of thing, but also how does it affect you, more importantly, as consumers, as retail clients? What does all this mean? What can we expect moving forward?
That's right. So let's talk about inflation real quick. Again, inflation is a large amount of dollars chasing after a few resources. So I heard a great analogy a few weeks ago, and we talked about this, in that if everybody was given $1 billion, imagine you had tomorrow $1 billion coming to you. You opened up your checking account, and there it was. Are you going to sell your house for what it's worth today if you've got $1 billion more in your bank account?
Probably not.
Probably not. Are you going to go to work for the same amount that you're earning today if you have $1 billion in your bank account?
Probably not.
Probably not. So if you have more resources, what you're going to do is you're probably going to demand more money for your resources and for your time. And that's effectively one of the problems that we have, is that there's such a huge amount of cash flow, huge amount of resources that are coming in, i.e. through federal stimulus, that are helping people reevaluate the value of their time and the value of their resources. So if people are getting paid in stimulus checks, for instance, it's harder for employers to incentivize them to go to work for a relatively low wage. And if employers need workers to have their company work, then they're going to have to pay more. And if employers are paying more, how does that filter down to you?
That's right. With cash balances in the bank and net worths, especially at all-time highs, people have more money than they're used to. So $10 an hour, $15 an hour, even $30 or $40 an hour in some jobs doesn't mean as much to a lot of people as it did 3, 5, 6 years ago.
Yeah, I have a friend of mine who runs a sandwich shop in town, and about a month ago, he was literally in the middle of rush hour, and one of his workers saw that he had a check hit his bank account from the IRS, and he took off his apron and walked out in the middle of the rush hour, right? And so that puts a lot of pressure on businesses. So when we look at that, when we look at the difficulty it is for employers to be able to keep employees, then all the natural outcome of that is that we as consumers are going to have to pay more for the goods and services that those businesses provide.
Because ultimately, why is every business in business? It's to maintain a profit, right? If you're in business and you're not making money, your business isn't going to last very long. So how do businesses maintain profits while paying people more? They have to charge more to the consumer.
That's right. And it's really one of those challenges, because it's really every single industry. Trucking companies are having a hard time finding drivers. Manufacturers are having a hard time finding employees. And granted, it's not necessarily the employee's fault, right? It really isn't. Like if you've got enough money on which you need to live, and you may not be happy at work, well, there's got to be an incentive there for you to get up and go. Right? So, I mean, it's one of those things where when we're looking at the markets and we're looking at the economy and we're looking at the challenges ahead, it really is one of those talking points that is really on the forefront of our minds every single day right now. Because as long as consumers have the money to spend, companies need to have the ability to provide those things that consumers want. But if you go to order a car, you might not get delivery of that car for a year because it simply can't get made.
That's right.
Because all the way down the supply chain, there might be a company that has plenty of supplies, but if they can't get those supplies on a truck and get them from point A to point B, you're just not going to get your truck. You're not going to get your everything from bourbon to groceries to you name it. We're talking about Christmas gifts. It's going to be tough for parents to get Christmas gifts to their kids. You might have to go out and shop for Christmas gifts now because they might be gone by December.
That's right. Furniture, I'm moving to a new location in January, and the places that I've started looking at for new furniture are saying months out for orders.
For a couch.
Yeah, for a couch.
I mean, so it's one of those challenges where we have to deal with it. As financial advisors, we always want to make sure our clients have enough savings in the bank to be able to make it at least 6 months. 6 months at the low end, it should be the amount of cash that you have in the bank. But there's a conundrum, because 6 months ago, the cash that you have in the bank to cover 6 months of expenses now may only cover 5 months of expenses. Yeah. So you really have to be careful. If you are getting pay raises, if you are getting cost of living adjustments at work, make sure you're allocating enough to your savings accounts to be able to get through a period where gas prices could go up, groceries will go up. If you want to make sure your kids have a good Christmas, plan ahead on that, because if you're caught holding the bag in December, you're either not going to be able to get them the things that they want, or you're going to have to pay a significant premium for them. Right?
Savings, cash in the bank, that comfort level, that safety gland might need to be raised a little bit due to the inflation we've seen, increased prices. And there's nothing wrong with that. It's just an adjustment that some people might need to make to a financial plan or to their balance sheet.
That's right. And I think about inflation too. Like, we've all had this experience. If you go into a restaurant right now, you might wait an hour to get a table. But you're looking out at these tables, the restaurant might be half full, and you're going to pay the same amount. We were even talking before, you might even realize that a meal, the cost of a meal might be up 10, 15%. I don't know. What was $12 6 months ago might be $15 today. But if you have to wait an hour for a meal, and let's say you are paying the same amount today as you were 6, 7 months ago, well, that hour wait, instead of what would have been a 5-minute wait before to get a table right away, well, you are paying the same amount, but you have less time, right? So that's an inflationary pressure on your time. That gives you less time to be productive, whether it's at work, whether it's with your family, you name it. So all these little bottlenecks add up to trillions of dollars that could hurt the ultimate economy. If you have to go to CVS to pick up a prescription during the workday, and that takes you 45 minutes as opposed to 5 minutes, that's less productivity that you have at work. So, I don't want to be all negative in this show, but it's just one of those things where it's just so frustrating, right? And if it sounds like I'm venting, it's because I'm venting. It really is.
Well, no, these are just conversations that we're having, so sharing them with you all is kind of what we had in mind. But the time thing is such an interesting perspective because I think we forget that sometimes. When we think about resources, a lot of times we think about tangible things, right? Food, money, that's what we've talked about. As advisors, we talk about these all the time, but time is one of those things that we forget, and it slips away from us, and it happens to me. I look up and I mean to spend 15, 20, or 30 minutes on something, and it might end up being an hour and a half. Well, that's an hour extra that I could have been doing something else. So time as a resource is an incredibly important topic in financial planning. It really is.
Yeah, it absolutely is. And and the last point, it's the week after Halloween. It is the Tuesday after Halloween, and Michelle, my wife, had a brilliant observation. So as I was just rummaging through my kids' candy, stealing those things that they don't like, right? You notice the fun sizes for candy bars, right? I look at the fun sizes of Kit Kats, and the fun size is like this big. It's literally like 1.5 inches long Kit Kat. And Michelle had a great point. She said, how is this fun? How is the fun size, this little morsel of Kit Kat, how is this fun? If anything, it's depressing. Because when you go to Walmart, Target, wherever you're buying these candy, it was like $10 for this bag of 25 little fun-sized pieces of Kit Kat, right? That's inflationary. I remember when I was a kid, we'd get a Kit Kat bar, and it actually had 4 things that you broke off, and each piece was about 4 or 5 inches long. You don't even remember that.
No.
Those are the good old days. We get full Snickers bars. We get full Milky Way bars. Now the fun sizes get smaller and smaller and smaller, but the prices don't change. When you go to the grocery store, you walk down the cereal aisle. I remember a family pack of cereal being a massive box with 2 bags of Cheerios in it. Now it's literally 1/8 the size, but the prices haven't changed.
Chips are the ones that get me the most. The bags of chips. But again, we don't want to just vent on this.
Why?
show.
Why? What's the deal with chips? When you open up a bag of chips, it's mostly what?
Air.
And if you look in the last 12 months, it's more air, right? And it's one of those things where I know that we're just kind of beating a dead horse, but this is why saving for your future matters. Because especially for retirees right now, we know that the Social Security Administration just announced a significant cost of living adjustment.
Close to 6%, 5.9%, I believe.
Year over year, 5.9% increase in Social Security. It's the largest, I think, in 2 decades. It's just a massive amount.
It's a big raise.
And with low interest rates, and we've talked about this in the past, it's extremely difficult time for retirees with low interest rates, potentially rising inflation. We've already seen year-over-year inflation. Is it going to last? Nobody has a clue, right? But these are the times right now where the rubber meets the road, because just because there's inflation, LG&E is not going to give you a break on your gas bill. The grocery store isn't going to reduce prices. As a matter of fact, they're probably going to give you less goods and services for the same that you've paid in the past. Fuel prices. Last night, I've got high-octane fuel required in my car. It was over $4 a gallon for fuel Gas prices aren't going down. If you want to travel, if you want to enjoy, if you want to spoil your grandkids in retirement, you want to do the things that you've dreamed about doing, it costs more today than it did 2 years ago, than it did 10 years ago, and it will most likely cost more in 5, 10, and 15 years. And it's so important, more important now than ever, to be able to recognize how it affects you on a daily basis, so that if you don't have a plan, if you don't have a team to help you, you need support to be able to work through these relatively unprecedented times.
And that's really our goal as advisors when we're meeting with our clients, especially when planning for retirement. That's kind of the bread and butter of what we do a lot of times. It's how do we make your money last? How do we optimize your balance sheet and where your money's located and what types of accounts to where you feel good about the future and you feel like it's going to be okay. That's what our goal is to help people figure that puzzle out, because everyone's is different. And this is such a huge topic in those conversations. And oftentimes, it might result in having more risk in equities and investments. If your stocks are growing, then that is a hedge against inflation, right? But that entails risk. So all these sorts of things are items that we're talking about all the time, and hopefully us just kind of conversating about it, talking about it, might open some eyeballs or help you kind of think about what's going on in our minds.
Yeah, and one of the things that we do too is with our fund partners and our money managers, one of the things that we're asking is, well, how do we define risk? Because historically, the risk tolerance questionnaire is something that we do for our clients. We measure risk for our clients. We use a great program called Riskalyze, where if you come and sit down, within 10 minutes we'll ask you 6 very simple questions where you and your spouse, you and your partner can look at each other and try to figure out exactly what your risk score is. Between 1 and 99, we want to make sure we gauge what your level of risk is and you understand what your level of risk is. But what if you were cruising at a 55 mile an hour speed limit, or if that was your level of risk, a moderate mid-level type investor, 20 years ago your portfolio may look a lot different than what it does today. So one of the things that we always do with our fund partners and the relationships that we have across the country is we're looking for alternatives to traditional ways of investing. So we're looking at real estate. You might be looking at international investments, emerging market investments, international debt, and things like that, because quite frankly, there is nobody alive that has managed money in a rising interest rate environment. And we have the largest demographic in our country are baby boomers. The largest demographic are retirees in our country. And they're just risks that nobody alive has ever managed money through. And understanding these questions, understanding that what worked 20 years ago may not be what will work the next 20 years, understanding your level of risk, understanding how a diversified portfolio and having different sorts of asset classes that will complement each other in different kind of markets, it really is more important now than ever. And again, if it seems like I'm on a bit of a rant, it's because inflation is here. Right now it is more obvious than any time in the 38 years I've been on this planet and the 20 years I've been in financial service. It's more obvious now than ever before. And it's such a wake-up call because we have been spoiled these last 10 years. We have been spoiled. And quite frankly, hopefully that this is coming through as more passionate rant than it is as anything else.
Well, and where there's challenges, because what I hear, what we talked about are some challenges. So what our job is to do, and what we always want to do, is to find opportunities. So in those challenges, where there's any challenge in life, I've always believed that there's opportunity in that. So where do we as advisors find those opportunities for our clients? Where do we, whether it's maybe not even in financial planning, but just in other areas, when challenges arise, how do we find opportunities? That's really our goal.
Yeah, and here's some. If you're the young kid that walked out on my buddy when it was rush hour at the restaurant, and you're making that check from the stimulus, go back to work. Save the money you earn at work. Put that in an investment account, because if you're 19 or 20 years old, work even harder, save even more now, because I promise you the more you save now, time being the best and most powerful asset that you have when you're young, let that work to your advantage. So if you don't have a job and you're collecting stimulus, go out and find work and save as much money as you can, because there's opportunity out there for you to find purpose, to find meaning, and to drive this economy out of what potentially could be recessionary. It's not right now, but quite frankly, if we continue to have a worker glut, it could be, right?
Yeah. And with young people, that's such a great point, because there are employers that want to hire good, young, sharp, technology-savvy, working individuals. There's a group of millennials. Some people view millennials, I know, as lazy maybe. Some people view them as hardworking. I think there's both ends of the spectrum, but really hardworking young people, there's so much opportunity out there. There really is.
Well said. Incredible. I mean, more opportunity now than ever. You can literally go write your own course. Just go to work, show up, and you'll learn amazing. You'll learn what your potential really is.
Now, Kyle, to close the show, Kyle had a really good joke, a Halloween event that I want you to share about the kid and the costume and crossing the road. So Kyle, let's hear it.
All right, so that's Ben's way of reeling me in. Well done, well done, my friend. All right, so here's what happened. So we have 4 children, Michelle and I. We were leaving the neighborhood that we were trick or treating in, and there were kids everywhere. And I was doing maybe 5 miles an hour, and all of a sudden on the right hand side, I saw this kid in a chicken costume that he looked like he wanted to cross the road, and he did. He stepped out in front of me, and I stopped, and then he jumped back because his parents told him not to jump in front of my car. But we rolled up next to him. I rolled down the window, and I looked at him, and I said, "Hey, kid, why are you crossing the road?" He was in a chicken costume. And he looked at me, and I at him, and his parents were chuckling in the background, and he looked at me and he said, "Ha! I get it now." And we drove off. So he didn't answer. He didn't tell me why he was crossing the road, but I don't even know he did. I ultimately think
I'm a sucker for cheesy jokes, and that one just got me. So
it was well timed. You know, it's one of those things that you look at getting situations, and after it's done, you wish you had said something. I said exactly what I wish I said. In all humility. So with that said, here's what we'll do. We'll close it out. Say, look, bottom line is this. Inflation is here right now. Do we have any idea how long it's going to last? Do we know how bad it's going to be? No. We do know that there is a supply glut. We know that there are shipping containers off the California coast that have God knows how many goods and supplies that Americans want to buy, but we don't have the people working at the ports to be able to get them in. And granted, it's a supply and demand issue. Bottom line is the price, or the price that employers are willing to pay, isn't what employees are willing to receive. So the market will ultimately work itself out. Ultimately, we will see the supply issue come through. We will see supply meet demand. You will get the cars that you want, the toys that you want, but all it is for me is just a stark reminder of why financial planning is so important, why you need to save for a rainy day, why those historical scenarios that you see and the stories we read about events that happened in the past, we are no different, we are no better, we are no worse than our forefathers that came before us. And what we need to do is understand the past so we don't necessarily repeat it, but we can be prepared for the future. And having a plan, having a team, having foresight to know and understand where you are so that you can get to know where you're going or have an idea of where you're going, that's how you'll be able to live comfortably and confidently in retirement. And living richly is about enjoying the time that you have, doing the things that make you happy, and having the resources to be able to do it. And that's what we're all about here at KPP. So
couldn't have said it better myself.
That's it. So on behalf of Ben Hopper, myself, and everybody here at Kentucky Planning Partners, thank you for watching. If you have any questions, concerns, give us a call, 502-394-0400. We are located at the Flash Q building on the corner of Shelbyville Road and Hurstbourne Lane in the heart of Louisville's east side. On behalf of everybody here, thanks for watching. We'll see you soon.